Welcome back, focused learners. Let's jump right into our latest explainer. Today, we're pulling back the curtain on an absolute giant in the fast casual dining world, Chipotle Mexican Grill. Our goal is simple and direct. We're going to provide you with a pure, data-backed financial due diligence report on their first quarter of 2026. No noise, just the cold, hard numbers. Let's get right to it.
Okay, here is our roadmap for today. We'll start with a Q1 2026 earnings snapshot. Second, we're breaking down the margins. Third, balance sheet health. Fourth, valuation metrics. And finally, Wall Street sentiment.
Section 1. Q1 2026 Earnings Snapshot.
To really wrap your head around Chipotle's footprint right now, just consider their trailing 12-month revenue, $12.14 billion. I mean, that is an absolute mountain of burritos and bowls. It really just grounds us in their sheer market scale and, honestly, their formidable pricing power over this past year. But hey, bringing in the cash is only half the battle, right? Keeping it is the real trick.
So let's talk actual profit. Q1 2026 net income came in at $302.8 million, which is about 23 cents a share. Now, if we rewind to Q1 of 2025, they pulled in $386.6 million, or 28 cents a share. So, we are looking at a pretty noticeable year-over-year dip in raw net income here. And this kind of sets up a mystery for us. With revenue growing so much, where exactly did those profits go this quarter? Well, the mystery clears right up when we look at the GAAP versus non-GAAP narrative. Actually, general and administrative expenses jumped significantly from $172.8 million up to $203.7 million. Why? Well, it wasn't slow sales, it was highly specific operational events. For one, Chipotle hosted their massive biennial All Managers Conference in Q1. Plus, they paid out some pretty heavy performance bonuses and bumped up wages. Oh, and to top it all off, their effective tax rate climbed to 25.4% because of fewer tax credits and some equity vesting changes. So really, it was targeted internal investments and tax adjustments driving those costs up, definitely not a broken business model.
Section 2. Breaking down the margins.
All right, starting right at the top line of profitability, they are sitting on a very healthy gross margin of almost 40%. Now, once we strip out those operating expenses, that big managers conference and the higher wages we just talked about, we land on an operating margin of nearly 16%. And finally, after Uncle Sam and all other obligations take their cut, the pure bottom line profit margin is resting comfortably right around 12%. This perfectly illustrates just how effectively Chipotle translates raw ingredients, the chicken, the guac, the beans, into actual tangible profit for its shareholders.
And wow, this brings us to their return on equity, coming in at a staggering 49.23%. Whenever you see an ROE this high, it is telling you a really compelling story about incredible capital efficiency. Despite rising overhead and those targeted Q1 expenses, management is still squeezing immense value out of the shareholder capital they're deploying.
Section 3. Balance sheet health and cash flow. Okay, at first glance, a current ratio of 0.92 means they actually have slightly more short-term liabilities than short-term assets right now. And a debt-to-equity ratio of 2.18, that looks a bit heavy, especially with total debt sitting at $5.25 billion compared to $871 million in cash. Now, if we stopped right here, we might be a little worried, but in proper financial due diligence, we absolutely have to look at cash generation to get the full picture.
And here is that crucial missing puzzle piece, free cash flow. Chipotle generated a massive $1.51 billion in free cash flow over the trailing 12 months. This is literally the lifeblood of a business, the actual cash left in the register after paying for all operations and capital expenditures. That $1.51 billion proves they have more than enough liquidity to comfortably handle that $5 billion in debt, all while funding their ongoing expansion.
Section 4. Valuation and key metrics.
Check out the contrast between the trailing and forward price-to-earnings ratios here. The stock is currently trading at just over 29 times its past earnings. But look what happens with the forward PE. It drops to 26.90. This gap is super interesting because it clearly indicates the market fully expects their earnings to grow meaningfully over the next year, which brings that relative valuation down.
Just to round out the valuation picture, let's quickly walk through some enterprise metrics. This is the pure quantitative context that professional analysts use to assess value. So, an enterprise value to EBITDA of 20.44 and an EV to sales of 3.75 definitely shows a premium valuation. But honestly, that's pretty typical for a market leader with such a high return on equity. Then there's the PEG ratio, which measures the price against expected earnings growth, sitting at 1.98. Usually, anything near or under 2 is seen as fairly reasonable for a high-growth compounder. Basically, these numbers are telling us you are absolutely paying for quality here.
Section 5. Wall Street Sentiment. Looking across 35 analysts who currently cover Chipotle, the consensus solidly tilts positive, landing on a moderate buy rating. Now, I always like to frame this properly. This is Wall Street's math, their collective opinion based on the data, not our own personal endorsement. What it means is they've digested those Q1 expense anomalies we discussed, and they are looking forward.
And backing up that moderate buy rating is an average price target of $43.86. According to market data, that represents a pretty significant projected upside from current trading levels. The street clearly believes Chipotle's core operational engine is still fully intact.
Let's just trace how we got here to really understand the current momentum. Back in June 2024, they did that massive 50-for-1 stock split, which made shares vastly more accessible to everyday investors. That was followed by the April 2026 release of the Q1 earnings we've been analyzing today. And all of this history has led us right into the highly anticipated Q2 earnings call, scheduled for July 29, 2026.
Which sets the immediate stakes right here. These are the exact financial hurdles Chipotle needs to clear in that upcoming report. $3.33 billion in quarterly revenue and earnings per share of 32 cents. Basically, the market is expecting a strong bottom line rebound after those conference and tax bumps back in Q1.
So this brings us to the ultimate question to wrap up our explainer today. Will Chipotle's pricing power continue to outpace its rising operational costs in Q2? I mean, they've shown absolutely incredible capital efficiency, but with wages and overhead climbing, July 29th is going to be the ultimate proving ground. Keep a close eye on those margins, folks. Thanks so much for joining me today, and keep learning.